AI has turned your diversified index fund into a concentrated bet on a tiny slice of the market. Here's what almost no one is explaining clearly. Just 41 AI-related stocks, roughly 8% of the S&P 500's constituents, now account for about half of the entire index's market capitalization. That means if you own a broad US equity index ETF, around half of your money is effectively exposed to AI, whether you realized it or not. Welcome back to AI Assets. Today we're going to break down three things: why this AI concentration matters for investors right now, what the market is missing about this setup, and how to position before this structure either pays off massively or cracks under its own weight. Let's start with the investor context. For the past few years, AI has quietly become the dominant engine of the S&P 500. Those 41 AI-linked companies have driven a large share of the index's gains since the start of the AI boom. In other words, the S&P 500's rally is not broad-based strength. It's a narrow leadership story centered on AI infrastructure, mega-cap tech, and a handful of software and platform plays. The top 10 US stocks now account for around 40% of the S&P 500's market cap, and a big chunk of that concentration is directly tied to AI. AI-linked companies are approaching nearly half of the index by weight, up sharply from pre-ChatGPT levels. So if you own an S&P 500 ETF thinking you are diversified, you're actually sitting on a heavily concentrated bet on one cluster of companies and one narrative. That's the first thing you need to internalize as an investor. Now, what is the market missing? Most commentary stops at concentration is high, or this looks like the dot-com bubble. But the AI story today is more nuanced than that. First, today's AI leaders are not profitless concept stocks. They are, in many cases, deeply profitable giants: Nvidia, Microsoft, Alphabet, Amazon, Meta, and others, generating billions in free cash flow and funding their AI capex from strong balance sheets. Forward valuation multiples for some of these names are far below the extremes we saw in the dot-com era, even though concentration levels are similar or higher. Second, AI is creating multiple layers of concentration risk, not just in stock indices, but in infrastructure and the broader economy. A small number of companies dominate AI accelerators, data centers, and model access, with one or two players still controlling the majority of the high-end chip market. If anything goes wrong in that cluster, regulation, technological disruption, a capex pullback, the shock can cascade through markets much faster than in a more diversified setup. Third, the concentration trap works in both directions. While AI remains in favor, high concentration reinforces momentum. Index flows, passive allocations, and benchmark-hugging managers keep piling into the same names, pushing prices higher. But once sentiment cracks, that same concentration turns into fragility. Index performance becomes hostage to the derating of a small group rather than the health of the full economy. Most investors are either ignoring this or treating it as a binary question: bubble or no bubble. The better question is, does the concentration profile of your portfolio match your risk tolerance? Now let's talk about what happens next and how to position smart. There are three key timelines to watch. First, AI earnings and capex cycles. Markets now track not just how much companies are spending on AI, but whether investors reward spending or only reward clear AI payoffs. We've already seen examples where strong AI monetization leads to stock surges, while aggressive AI capex without visible returns triggers sharp sell-offs. Second, policy and regulation. As AI becomes systemically important and half of the main equity benchmark is tied to it, governments and regulators will be under pressure to manage systemic risk. That can mean new rules around AI safety, data usage, competition, and infrastructure, all of which can impact valuations and concentration dynamics. Third, index construction and investor behavior. We've already seen special rebalances in major indices when mega-cap weights got too extreme. If AI concentration continues to climb, more investors may shift towards equal-weight indices or factor strategies that explicitly reduce dependence on the top handful of names. That would gradually redistribute flows away from the most crowded AI leaders. So how do you position in practice? Number 1. Understand what you own. If you hold broad index funds, accept that roughly half of your equity exposure may be effectively tied to AI companies. That doesn't mean you should panic, but it does mean you should decide whether that concentration matches your actual risk profile. Number 2. Distinguish between AI quality and AI narrative. High-quality AI names combine strong profitability, clear competitive moats, and demonstrated return on AI investment. Narrative names lean heavily on the theme, but don't yet show durable cash flows. In a concentrated environment, the biggest drawdowns often come from narrative names were carried upward by the theme without fundamentals to back them. Number 3. Think in layers rather than in all-in AI or zero AI. You can keep core exposure to the AI ecosystem while diversifying across sectors and index constructions, for example, by mixing cap-weight and equal-weight strategies, or complementing AI-heavy indices with more cyclical or defensive exposures. The goal isn't to avoid AI entirely, it's to avoid being unintentionally over-leveraged to one theme. The bottom line is simple. AI companies now make up nearly half of the S&P 500's value, but only a tiny fraction of its names. That's unprecedented concentration around a single narrative, and it's reshaping what diversification really means in public markets. If you want to stay ahead of that shift, instead of reacting after the fact, subscribe to AI Assets. We break down the AI stories driving markets with a focus on what the data actually says and how to position before the crowd catches up. And I'd like to know your view. Do you think having roughly half of a major index tied to AI is an acceptable risk in a modern portfolio, or a concentration trap investors will regret later? Share your thoughts in the comments below. I read every single one.